That's right, we're here to talk about a boring stock, but one I love. Cisco Systems. That's right, this is definitely widely considered a pretty boring stock in the market, no doubt. If you look at the 5-year history of this thing, not much going on here, just kind of boring. But in times like this, they are rocking it. So there's reported earnings after hours. We're going to look at those. This wisdom teeth pain is not stopping me from the grind, okay? It will not stop me. Up 1% after hours. Let's take a look at these earnings and see why. So Cisco reported a non-GAAP EPS of 79 cents, which beat by 8 cents, and a GAAP EPS of 65 cents, which beat by 9 cents. So a good beat in terms of profitability. Definitely exciting on that aspect. Revenue of 11.98 billion, which was down 7% year over year, 7.6%, but they did beat by 130 million on that aspect. So nothing major on that, but a beat is nice. Non-GAAP gross margin 66.6 versus 64.6 of last year, and product gross margin of 65.8, and service gross margin of 68.9. Deferred revenue was up 7% year over year at 18.6 billion. Okay, let's get some of the finer details before we get into that press release. Cisco was up post-market after posting that to be top and bottom line estimates with revenue that didn't decline as much as forecast. With the bright spot gains in services and security products, which does not shock me. It's one thing that I expected for this company to continue growing, where you might not see the modems for this company maybe grow. The hardware segment, you're probably going to see the services and security segment grow, and I'm glad to see that it did. So we'll take a look at those numbers in a little bit. Operating income was flat at 4.2 billion. Good amount of cash brought in for sure. Net income dipped just 2% to 3.4 billion. That is a good net income line for this company. Very nice. Deferred revenues rose 7%. Of that, deferred product revenues rose 17%, while deferred service revenues rose 1%. From revenue breakdown, you saw infrastructure platforms was down 15%. Applications down 5%. Security up 6%. Other products down 27%, and services up 5%. So services is going to be a big segment for them in the future. It already is a big segment, but it's only going to grow naturally in this current environment that we're in. Cash flow from operations fell 2% to 4.2 billion. Liquidity was 28.6 billion at quarter end, compared to 33.4 at the end of fiscal year 2019. But consider this as quarter 3 for this company, so that comparison is going to be from 9 months prior. So for Q4, it's it's guiding EPS of 74 cents to 74 cents. Interesting. And revenue is expected to decline 8.5 to 11.5% year over year. Sees gross margin of 64 to 65% and operating margin of 31.5 to 32.5. Okay, let's look at that press release. Revenue 12 billion. We saw that. Very nice numbers on that aspect. So let's take a look at some of these good things. So for employees, they've got 95% of their global workforce working from home right now. Pretty crazy. They had a pretty seamless transition because a lot of them work from home already. We build technologies that allow organizations to stay connected, secure, and productive. For the 5% who must be in the office to perform their roles, they're focused on the health and safety, taking the necessary measures and precautions. Pretty cool for them. Yeah, very exciting as far as that's concerned. From revenue by geographic segment, America's down 8%, EMEA down 8%, APJC down 9% as well. Product revenue was led by growth in security of 6%. Everything else was down really besides their security and services revenue. So definitely something to consider on that aspect, but it's not an unexpected number, all things considered. So as far as capital allocation too, in the third quarter, we returned $2.5 billion to shareholders through share buybacks and dividends. We declared paid a cash dividend of 36 cents per common share, or $1.5 billion, and repurchased 25 million shares. Pretty cool, of common stock under our stock repurchase program at an average price of $39.71, which, as you can see, was a decent deal for them. So after the third quarter, they closed an acquisition for Exablaze, a privately held designer and manufacturer of advanced network devices aimed at reducing latency and improving network performance, which is exactly their business. So, yeah, pretty exciting there. They made a good acquisition. Very curious as to what that amount is. What that amounts for them, but here they gave guidance, which we saw. Guidance isn't bad on this company. It's not bad, all things considered, but what can you say? Could be better, could be worse. Finally, we look at the balance sheet. Current assets on this company of $10.3 billion, and that's versus 9 months ago $11.75 billion on cash and cash equivalents. Total overall current assets of $41 billion versus $47.7 billion 9 months ago. A little bit of a decrease on that aspect. Total assets of $91 billion versus $97 billion. So nothing too crazy. $91 billion is a lot of cash for this company. And you also see from a total current liabilities perspective, they decreased that number by around $7 billion, which is where some of that difference is between the current assets. And then they paid down some of that short-term debt. Good for them. It was due, so they had to pay it. But and then total liabilities for this company of $55 billion versus the $64 billion 9 months ago as well. So they paid some long-term debt down as well. Very exciting to see on that aspect. Around $3 billion worth of long-term debt. So shareholder equity here of $35 billion. This company's got a very good balance sheet. It's a consistent dividend payer, and I plan on holding Cisco for a while. I like the company. It's not a big portion of my portfolio, but I feel pretty good about Cisco. It's a company that's consistent. I know what they're doing. I know the product. I know the services, and I'm confident that they'll be rocking it for a while. So good job to Cisco for this quarter.